Good morning. I always record these not always, usually Saturday morning. So that's why I say good morning. You may be watching this at night, in which case it's good evening. In any case, hello. Hope you had a great week. If you are not started on your regional market analysis yet, I strongly urge you to devote some time to that this week because it is due on next weekend. And if it's not your forte to work with numbers, you will also want to devote some additional time for this week's Chapter 5 because it primarily has to do with financial reports and budgets. If you have some accounting or bookkeeping background or are accustomed to looking at financial reports and budgets, you will likely find this chapter to be a cakewalk. If this terminology is new to you and you have not ever seen a budget or financial report for a business or a homeowners association or a state agency or any other place you might work or be, then there will be a lot of strange new things here for you to digest. Some people's minds really work well with numbers, and for others it's a little more challenging. I don't know which kind of person you are, and I hope you're all good at numbers, but we're not all good at everything, so we're going to assume there are some people that are going to find this a little more of a pain in the butt, as it were. Please do not hesitate to get a hold of me if you have any questions. I am available, as I said, in the evenings by phone, 208-255-6399. You're always welcome to email me. I try and check at least twice a day. I am working during the day, but I check usually at noon and then again in the evening, and of course during the weekends on email. So I'm available if you have questions. I really want you to do well and be successful. So please let me know if you're having some trouble with this. Chapter 5, as promised, if you're a numbers person, this is your week. The book goes into a number of topics. Primarily, the two that I'm going to touch on today are the financial reporting and how to calculate some operating income numbers, and also how to prepare a budget for a property. The book touches on some income tax discussions for investment property. I don't intend to spend a lot of time on income taxes because, first of all, the tax laws change all the time. I don't know what the future holds with that. Secondly, I'm not a tax accountant, and I think anyone who has investment properties would be well advised to retain a tax accountant to prepare your taxes. Therefore, if you need advice on the tax consequences of an investment decision, that's beyond the scope of this class, and it's above my pay grade. I'm not going to go there. So I think you should read the chapter fully and read the income tax part, but I'm not going to spend much time on it in terms of the quiz or the final. Hope that will take a little bit of a burden off you. There are a couple of things that are really important for a property manager to know what to look for, and that's the money. Not only taking in the rent and how you handle the money that you take in from the tenants and working with the owners to pay expenses and pay the owner what he's entitled to, but how to do the financial reporting and prepare a budget so the owner knows what to expect during the year and so that you can give a true picture of the performance of the property. That is a big requirement for a property manager. It gets back to those fiduciary duties we discussed early on, where you owe honesty and loyalty and good faith to the owner of the property. That includes a true picture of the financial situation of the property. There are some terms in here that I think might be new to some of you. The first one is gross income. That is all of the income that a property takes in. That's rent. If you have a pay washer and dryer on the property, it would be money that comes in from the laundry. If you charge for parking, that would be the parking fees. Any kind of income that, if you have vending machines, some office machines have vending machines installed, that would be an income. That gross income is the grand total of all the different kinds of income from a property. From that, you deduct your operating expenses. Operating expenses are expenses that you need to actually run the property. That is commonly things like utility bills, water, sewer, electric, gas, cable TV or internet, if you're paying those bills and the tenants aren't paying them themselves, property taxes, insurance on the property, repairs and maintenance. If a child throws a baseball through a window and it breaks, you have to replace the window. That's a maintenance item. Or if the water line freezes and it floods a unit, you have to repair that. That's an operating expense. The other kind of expense that the book talks about is a capital expense. Now, some people get mixed up between these two. Everything is not an operating expense that you might spend on a property. A capital expense is something that adds to the value of the property, and it's distinguished from a maintenance expense or a repair by the fact that it is treated differently on the financial reports, and it is also something that commonly is a large big ticket item that adds to the life of the property, such as a new roof. If you have a new roof on the building, that's a capital expense. If you're replacing all the windows just because the old ones are perhaps made out of aluminum, or they leak, or the seals are broken inside the double panes of glass, and so you decide to replace all the windows, that would be a capital expense. Those items are treated differently on the financial reports, and they are not deducted from the gross income. If you think about it, one month, let's say you had $10,000 in rent come in, but you went ahead and replaced all the windows, and that cost $50,000. If you deducted that cost from your gross income, it would show that you had an operating loss of $40,000, and that would be incorrect, because replacing the windows is not something that you needed to do to operate the building. You could have still done that without replacing the windows. You're just adding value to the property and increasing the value and extending the life of the property, most likely. Dealing with functional obsolescence, I believe, was the term used in a previous chapter. The other thing that comes off of gross income when you're doing financial statements is a vacancy and bad debt percentage. Unless you have the most wonderful tenants and the most wonderful property in the whole world and no one ever leaves and you never have a single thing ever vacant for one day, you are going to have some time in your property that you are not collecting income from that property. If you have a fourplex, it's likely that once in a while you'll have a unit that's vacant, that somebody moves out when their lease is up. It is very unusual to have a brand new tenant move in the very next day. Most commonly, you'll have some downtime where you'll have to go in and do some cleaning or maybe repainting, or perhaps that's a time that you select that you make some improvements to the property, like replacing the appliances and things like that. And so you won't be getting any income from the unit that particular month or months, and that has to be factored into your income calculations. So what's commonly done is a percentage is chosen of, say, 3 to 5% of your gross income, and that is deducted from the gross income in order to proceed with preparing your financial reports. It's kind of like level pay with your gas bill. You know that it's going to be higher in the winter when it's cold and less in the summer, but the gas company offers you the option of calculating what you think your total for the year will be, dividing that by 12 so that you pay the same amount each month. It's kind of the similar theory with the vacancy loss factor. You'll choose, say, 3% or 5% or more if you know you always have high turnover, and you will deduct that amount every month from your gross income when you're preparing your budget and when you're preparing your financial reports. This also includes not just vacancies, but bad debts. If somebody doesn't pay their rent for a couple months, you aren't going to have that income. So we don't include it on the financial statements because we don't have it. Most properties are handled on a cash basis, and that means you count the money as income when it comes into your hand, and you count it as an expense when you pay it out of your checkbook. So you're not trying to calculate any amortization or depreciation or anything like that for your, no accruals, I guess is what I'm trying to say. And we're not even going to talk about that. So this is just cash, just like you operate at your house. Money comes in, money goes out, and that's a cash basis. After you deduct the vacancy factor from your gross income, then you will deduct your operating expenses. And from that, the number that you get at the end is called net operating income. That's a very important number. We will use it a lot as we go forward in this class. So it's very important that you know how to calculate that correctly, because sometimes people want to put things in operating expenses that don't go there, and other times they're confused about how to make those calculations. So I want you to look at the examples in the textbook very carefully. They're very simplistic. We aren't going to be doing rocket science here, but if it's foreign to you, it might take a little time to wrap your brain around it, I guess is what I'm trying to say. So I think that how I have things set up in this class is that if you follow the examples, you should be able to do well, because you kind of just have to, look at the pattern and follow the example that has been given. Now, when you deduct, so to get net operating income, that's a number you need. Another calculation that many times property owners want to know is, what is my cash flow? How much money do I have in my hand every month after I've written all the checks? So in order to figure that out, you take your net operating income, and then from that number, remember we started at the top with the gross income and we're working our way down with deductions. After you've arrived at your net operating income, then you will deduct your debt service. What debt service is, that's your mortgage payment, okay? It's principal and interest that you're paying for money that you used to buy the property, or money that you have borrowed against the property. Now, again, debt service is not an operating expense. It's separate. It's calculated and deducted underneath the net operating income on your hierarchy of calculations. And so from net operating income, subtract the debt service, which is the amount that you pay each month or year on your mortgage, and that gives you your cash flow. Makes sense, right? I've got all my income in, I've subtracted all my expenses out of my checkbook that I needed to run the property, and then I paid my mortgage, and that's how much money that I have left. That's what the property brought in as cash flow. Now, if this is all something that you're way up to speed on, and I hope that you don't think I'm being too simplistic, and I don't think you don't know what you're doing. I just know from past experience that a lot of people have never seen some of these concepts before, and so I'm trying to kind of explain them as best I can, because the book kind of skims over a few things. Now, when you prepare an annual budget for a property, you want to anticipate all of the income that you might collect for the year. If you have a fourplex, we'll go back to that example. What is the rent on each of those units per month times 12, and you add that up as your gross income, deduct your vacancy and loss factor, that your bad debt and vacancy factor, calculate what you think your operating expenses will be for the year. Generally, you'll know what the property taxes are and the insurance, and you have a pretty good idea based on the past year what your utilities will be and that kind of thing. And after you've done that, then you will figure out what your debt service is and subtract that. So an owner can look at that and say, okay, here's how much I'm going to expect to take in, how much I'm going to expect to pay, and after my debt service is subtracted, how much will I have as cash flow? And so a financial statement typically is done every month, and then one big one at the end of the year to show the total year. The budget is done every year, and sometimes it's calculated several years in advance because an owner of an investment property will want to be able to plan for their investments, and maybe that's the time when you'll look at, I need to replace the roof. When's the best time for me to do that? And maybe you prepare a budget of capital expenses too, where you say, okay, I know the property has some issues, and so I need to replace all of the stoves and refrigerators in my units. How am I going to do that? Am I going to do them all at once? Am I going to spread out and do 1/4 of them every year for the next 4 years? So those are all decisions that can be made in conjunction with the owner, and so that would be another kind of budget you might run into, is a capital budget, where you're figuring out how to make some bigger investments into your property. The last thing that I want to touch on is what's called the cap rate. People get their brains twisted up about this all the time. Cap rate was described in Chapter 2, kind of glossed over. I've got a discussion board about that this week where you will be doing some calculations and evaluating the two properties that you evaluated last week. To compare them, you will take those same two properties and try to determine, if you can, some calculations on the cap rate, and then I want you to give me a little more analysis on those two properties based on the return on investment, and tell me which one you would recommend or which one you would choose based on all the information that you have. You'll be using the same two that you looked at last time. I've posted the flyers in the Module 5 unit again, along with the assignment, so please remember to keep working on Assignment 1, which is separate. And I wanted to just touch on cap rate a little bit because it's very simple. The cap rate is not any hard and fast calculation. It's almost an estimate. And the cap rate for a property is an indicator of risk. A high risk property, one that it could make a ton of money, or it could be a dog. You know what they say, high risk, high reward, right? Well, that will have a higher cap rate. And a very safe property will have a lower cap rate of, say, 4, 5, or 6. A high-risk property is, 11, 12, 13 cap rate. How the cap rate is calculated, you take the, I'm losing my mind here, the net operating income, and you divide it by the price of the property or the value of the property, times that number by 100. And that gives you the cap rate. It's not a percent, so don't put a percent sign after it. It's just a rate. Again, a somewhat confusing concept. You can work that equation backwards. You get to use that algebra now that you thought from 9th grade you would never ever need in your whole life. Here's a time when you will need to know how to do it. The formula is listed in the discussion board, and it's also in the book, but it's not in this chapter. I believe it's in Chapter 2. I want you to understand this concept because it's very important. When you are looking at purchasing an investment property, many, many times the cap rate will be included as an indicator of, as part of a description of the property. And I want you to understand what that means, and I want you to know how to figure it out. And I will also want you to know, if you have the cap rate and the net operating income of the property, you need to be able to work that formula backwards and figure out what price should you expect to pay for that property, because this is often how investment property prices are figured out. It's by using a cap rate and net operating income. I know that's probably a lot of information and perhaps very confusing for some of you. Let that percolate a little bit. Read through the chapter. If you still have questions and the examples don't make sense to you, please let me know right away, because we're going to use these things going forward and I need you to have a good foundation in them. I appreciate your attention, and I hope you have an awesome week. Thank you.